I'm going to be sharing about today's market news. Nasdaq's index fell for the second straight day, and the culprit of last Friday's sharp fall was found, an earthquake triggered by a CDS. So let's take a look at the market today. Today, Nasdaq Composite fell for 0.45%. S&P 500 also fell for 0.15%. And Dow Jones Industrial Average fell as well for 0.12%. Today, market closed mixed, with mostly the tech industries closed down and the banks also closed down, but varied in almost all of them varied less than 1%. Oil and gas continued to rise for another almost 1.5%. Nasdaq down for a second straight session. Rising Treasury yields weighed on technology stocks. The Conference Council Consumer Confidence Index slightly exceeded expectations in March. 2-year Treasury rates rose to above 4% on Tuesday. Rising Treasury yields have put pressure on stocks, especially technology stocks, as higher interest rates make future profits, such as those promised by growth companies, less attractive. Invesco Global Market Strategist Brian Levitt said Treasury yields rose for the second day in a row, while the stock market is dominated by economically sensitive sectors, such as energy and industry. Tech stocks are one of the laggards, in a sector that tends to fall when Treasury yields rise. Investors' recession fear are again in the spotlight. Goldman raised the chances of a recession over the next 12 months from 25% to 35%. The bank's chief economist, Mr. John Jesus, wrote in a note, "The risk is clearly skewed towards the banking turmoil still potentially have a greater negative impact on the industry." It noted that Goldman's forecast for a recession was still below market expectations, about 60%. A series of positive news Monday, including First Citizens' agreement to buy a majority stake of SVB, helped boost Wall Street. In addition, data showed that deposit flows from smaller institutions to banking giants have slowed. Truist Lerner, co-chief investment officer of the institutions, said Monday's U.S. stock rally was largely driven by some areas that had previously performed poorly. This is a post-oversold rally, and the lead led a pause, so I don't think the stock market trend has reversed, and there are no new leading areas. He said the news that First Citizens Bank bought a large portion of Silicon Valley Bank's asset was positive. On Tuesday, John Barr, the Fed's vice chairman of regulatory affairs, will address the Senate Banking Committee on the recent banking failures and the response of federal regulators. Before Barr's speech, Federal Governor Jeff Jefferson said the transfer of deposits from small to large banks could have an excess impact on U.S. small businesses that rely heavily on credit from community and regional financial institutions. Jefferson said, "We focus on the macroeconomy, but we also realize that there are some potential distribution problems if depositors transfer cash from smaller banks. Recent pressures on the banking sectors have led to fewer deposits in small financial institutions, and we'll have to see how this develops." On Tuesday, home prices cooled in January, with the national average of selling prices up just 3.8% from a year earlier, according to the S&P Core Logic Case Shiller National NSA Index, that was down from 5.6% in December. U.S. home prices have fallen for 7 straight months, but fell slightly less in January. This could be due to a brief drop in mortgage rates and the resulting surge in sales. Another data showed the Conference Board Consumer Confidence Index for March at 104.2 versus 101 expected, versus 102.9 last. The culprit of last Friday's sharp fall was found, an earthquake triggered by a CDS. Several regulators believe that a roughly $5.4 million Deutsche Bank deposit credit default swap deal could trigger a Friday's sell-off in Deutsche Bank shares and even an overall European banking stocks. Such contracts are often illiquid, so a single multi-million-dollar bet can cause a big shock in the lack of confidence. Several regulators believe a Deutsche Bank credit default swap deal could have triggered a sell-off in Deutsche shares and overall European banking stocks. A bet about 5 million euros on a swap related to Deutsche subprime debt could be responsible for the week of Friday's Deutsche panic, media said, citing people familiar with the matter. Regulators have spoken to market participants about the deal. Such contracts are often illiquid, so a single bet could cause a big market shock. It is unclear who made the transaction. Some of the data suggests that the deal was trading for hedge purposes, according to people familiar with the matter. In addition, a Deutsche Bank 5-year senior CDS deal executed on Thursday was also under scrutiny. Spokesman of Deutsche Bank declined to comment. The search for the cause of the Friday's plunge in the German bank highlighted the general lack of transparency in the asset classes. ARIA also called on global financial regulators to pay close attention to the CDS market, noting that the CDS market for a single stock is very opaque and very liquid. With only a few $1 million, it is possible to change the CDS spread of a large bank and affect its share price, possibly even affecting the deposit outflow. ARIA did not specifically name any banks. On Friday, Deutsche Bank's CDS insurance costs soared, reviving fears of banking stability in Europe and the United States. On the same day, European and American stock market earlier in the jack of bank stocks fell across the board. Deutsche Bank's European share fell as much as nearly 15%, their biggest intraday drop in the 3 years since March 2020. Safe haven demand was high, and the yield on 2-year U.S. and German government bonds fell 30 basis points. On the same day, Deutsche Bank, the German government, and the European Central Bank took turns to calm markets. German Chancellor Scholz called Deutsche Bank profitable since its 2019 reconstructing, and needless to worry. European Central Bank President Christine Lagarde told European leaders that the banking sector remains strong and will inject liquidity if needed. Deutsche Bank will redeem $1.5 billion early in 2028 in 2 months and receive regulatory approval. After the emergency statement, the market concerns appear to ease. By Friday's close, Deutsche Bank's European shares have paired losses to fall 8.5%, while U.S. stocks fell 3.1%, but both hit 5-month lows. Treasury yields also wiped out most of the day's losses late in the day. On Monday, Deutsche Bank shares rebounded significantly. SVB and Credit Suisse have recently triggered a banking crisis, with investors lacking confidence and panic looking for clues about whether other banks will face similar pressure, which could trigger a market earthquake. On this occasion, European banks and their regulators are trying to stress that they are closely monitoring the risk, and that the industry itself is well grounded. Deutsche Bank issued a report on Monday, citing its diversified deposit portfolio, which investors have focused on after the collapse of Silicon Valley Bank. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.